Welcome to Kitco News. I'm Niels Christensen, and welcome to our continuing coverage of the Mines and Money Online Connect Virtual Mining Conference. Today, we're speaking with the illustrious Rick Rule, President and CEO of Sprott U.S. Holdings. Rick, welcome back to the show. It's always a pleasure to talk with you.
Pleasure's always mine. I'm a Kitco fan.
So I want to get this from you first. I mean, at the start of the month, we saw gold prices shoot well above $2,000 an ounce, all-time highs. This is something we've been waiting for. We've backed off of those. Do you think there's more to come for the rest of the year, or have we seen the best gold has to offer?
No, I'm afraid that gold goes higher, probably much higher. It, of course, will go higher with lots of volatility. It doesn't mean it won't go down a little bit before it goes up. But I truly believe, for reasons that I think we'll discuss later in this interview, that the wind is truly in gold's sails, that the circumstances that are propelling gold higher are uniquely positive for gold and probably uniquely negative for most other aspects of your life.
Well, and so let's talk about this volatility. A lot of this volatility has been caused by our favorite topic, the Federal Reserve. We saw gold sort of give up that $2,000 area after the Fed minutes showed the committee talking. They see no benefit to capping interest rates. You know, gold sold off then, and now we've just heard Jerome Powell at Jackson Hole talk about the Fed wanting to have an average 2% interest rate now. This is causing a lot of the volatility. What's your thoughts on all of this messaging from the U.S. Central Bank?
I think it's messaging. I think the central bank has their task cut out for them, and I don't think that they're up to it. They have a circumstance where the voters and consumers and Wall Street won't let them raise interest rates. Interest rates need to stay artificially low, but they aren't getting the same fiscal stimulus economic stimulus for every dollar of fiscal stimulus that they add. So they're really, truly between a rock and a hard place. As you know from prior interviews, I'm not much of a fan of the Fed, but I have to say, given the set of circumstances that they have to do with, which is, from my point of view, effectively an impossible task, they're probably doing, from their point of view, as well as could be expected. Understand negative real interest rates for what they are. They're a war on savers by spenders. And in a democracy, the winner of that war is foreshadowed, given that spenders are so much more numerous than savers. And so from a political point of view, the Fed is doing the only thing that it can do. And I think that's very, very good for gold.
Well, I mean, it does feel like, we need to ignore the messaging and focus on the trend, which is interest rates are not going anywhere. Real interest rates are going lower. And, money is going to be continued to pump into financial markets to support this economy. I mean, is this where we go?
Absolutely. I don't see what their way out is. When I was a young man coming up in business, we had this now extinct species called the business cycle. We would have recessions. And if you had 5 or 6 good years, you needed to use those 5 or 6 years to tuck resources away in order to save so that you could weather the bad years. That's the way it was. We have decided in our wisdom that we're not going to have recessions and recoveries anymore. Every month is going to be July and August. But that's not the way life works. And I'm afraid that the Fed will discover eventually, well, they probably know it, but the voters and consumers will discover that artificially low interest rates, which is to say negative interest rates, are, as Buffett said, not a force of nature. They are created circumstances. And The benefit that they buy you is short term, and it comes at a fairly substantial long-term price. And I'm afraid eventually we'll have to pay that price.
Well, but it's also more than just monetary policy. I mean, we also have to look at fiscal policy as well. And I think coming into an election year, the election only a few months away, how does this play into gold? I was talking to one analyst, and they said probably the worst scenario for gold would be a Democratic president and a split House, because nothing is going to get done, or like just, a split government where nothing sort of gets done. And they just, that would be the worst case scenario for gold, because there's going to be no fiscal stimulus.
One thing that the Democrats and the Republicans always agree on is spending money. And so, unfortunately, the idea that a Congress and the president would act contrary to each other and no money would get spent is a false dream. H.L. Mencken famously said that elections are best characterized as advanced auctions of stolen property. The job of an elected politician is to steal on behalf of his constituents, while at the same time protecting them from theft. And so what you have is a house of thieves. And the idea that a house of thieves can somehow reform themselves and keep from stealing, can keep from making deals across gangs, if you will, I think is a false hope. I mean, the truth is, when you look at the gold landscape, you look at several factors. As you point out, fiscal policy, which is to say debt and deficits, continuing as long as they can get away with it. Artificially low interest rates, continuing as long as they can get away with it. Quantitative easing, which if you did it would be called counterfeiting, for as long as they can get away with it. And then, of course, the fourth factor, which is to say that from a historical context, gold and precious metals related equities are substantially underowned. It is estimated now that the market share of gold and precious metals related investment products is less than 0.5% of total savings and investment assets in the United States. The 3-decade mean is about 2%. So even if the three factors that we talked about don't propel gold demand really high, my suspicion is that the market share of precious metals and precious metals related assets reverts to mean, the 3-decade mean. And that would mean that demand for these financial products, precious metals and precious metals related assets, would somewhere between triple and quadruple the largest savings and investment market in the United States, which is precisely what I think is going to happen for precisely the reasons that you enumerated.
Well, has that wave started? And, get your opinion on Warren Buffett's, Berkshire Hathaway's bet in Barrick. Is that the first wave to crash onto this beach, as you say, of sort of money flooding into the market?
I don't think so. I think, first of all, what Buffett did is a rounding error relative to the money that he has to invest. But what I think is significant about it, I don't think he's betting on gold. I think he still regards gold as an inert investment and, quote, a pet rock. I don't think that's changed. What's important for the gold community to understand is that by Buffett's criterion, Barrick was cheap. And it was cheap even though he didn't like the product that it produced. He looked at the expected net present value of the free cash flow of Barrick, and he looked at how much he would have to pay for that, the enterprise value of Barrick, and he decided that the company was cheap. Ergo, gold stocks, by conventional investment methodology, are cheap. And I think that's really important. We've seen a pretty good move in the gold. I believe that the gold goes higher, but I believe that many of the gold stocks have not kept up with the appreciation that we've seen in the underlying metal. The hyper juniors, the below 100 million market cap being the notable exception, which have just gone absolutely crazy.
Well, that actually was going to be my next question is, some parts of the mining sector have actually seen a really good run. And I sort of wanted to ask, is there value still there then in the marketplace?
There is absolutely value in the marketplace, but you have to be very careful where you go. It has been my opinion for years that probably 15% of the listings, of the junior listings, are viable. The rest of them are dross. And that means that stock selection is paramount. It's always amused me that many gold investors criticize the Fed for printing counterfeit dollars, and then they cheer the Canadian dealer community for printing counterfeit share certificates. Because the truth is that the private sector is always more efficient than the public sector, and the dealer network can always print more phony baloney mining company shares as long as there's demand present. The purpose of that is to look at what's happened in the last 90 to 120 days in the financing market for the hyper juniors and be extremely cautious. Be extremely cautious.
Well, you're not the first person to say this. So, I mean, do you think there's too much money flooding into the junior, like especially in these private placements? I mean, there's been a lot of money raised through private placements.
Way too much money, and really, 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 truly dumb money. The sector, the junior sector, the hyper junior sector went from being very cheap, historically cheap a year ago, to being insanely expensive. There have been companies where not much has changed with regards to their asset. Admittedly, the gold price has changed, that had $5 million market caps that have now raised $20 or $25 million at $80 million pre-money valuations. This is truly the return of the dumb money. Having said that, if you look at the gold equity space overall, I wouldn't describe it as expensive. Witness Buffett buying into Barrick. But witness particularly the middle market companies, the single asset producers, which always traded a discount to multi-asset producers. Some of them are really, truly cheap on a free cash basis. And my suspicion is that if they don't move higher as a consequence of buyers like myself buying them for relative valuations, they'll move higher as a consequence of larger multi-asset companies taking them over and having that valuation gap disappear. So I think it's important when we talk about the gold stocks to understand that leadership is moving around in terms of market capitalization. This is the first time in my career, by the way, that the juniors and the hyper juniors have moved before the rest of the market. I suspect it's due to social media. I don't really know why. I suspect that there's a narrative-oriented generation that gets their information differently now than they used to. It's certainly an interesting phenomenon to watch.
So basically then, so what you're saying, I guess, like, for generalist investors, they should be looking at, sort of the mid-tier producers. Right? Is that the key? Is producers, the companies that are making, that are getting free cash flow?
My preference is that the generalist investors who really don't know the sector buy the best of the best. Now, ironically, in a gold bull market, those companies will underperform the indexes a little bit because as the gold price goes higher, it won't move their already efficient margins higher. But what I've learned in the gold business is that when you come into a gold bull market, it's truly a dramatic circumstance. And even if you underperform the market a little bit, if you capture the beta but de-risk it, which is something that a generalist has to do, you do extraordinarily well. The Kitco viewers, of course, are often not generalist investors. They've been around metals and markets for a long time. They have more sophistication. They have more tolerance for volatility. And it's those investors that I am suggesting begin to pay attention to the valuation arbitrage evident in the market between the mid-tier companies that are generating very high free cash margins and the best of the best. The generalists, the newbies, they need to be in the best of the best.
So Barrick and Newmont.
Well, there are other names too. But, the Francos, the Wheatons, the Agnicos, the Barricks, the Newmonts. By the way, this is for illustrative purposes. These are not securities recommendations.
Do you see, like this, you see more value in the market? So, I mean, how long do you think this gold bull run lasts then? I mean, is this, the Fed signaled that they don't see moving interest rates until, at least the end of 2022. Is that even realistic in this environment? It feels like it's going to be much longer than that.
My experience has been a real gold bull market, which is what I think we're in. I don't think we're in a rally from an oversold bottom. Real gold bull markets generally go for a decade. My initial experience was 1970 to 1981, 11 years, admittedly punctuated by 1975, where the market fell by half. And then, of course, there was the 2000 to 2011 bull market, admittedly punctuated dramatically by 2008. Many people are saying, Rick, the gold price has already gone from 1100 to 1950. Have I missed it? Well, if you look at the most tepid of those two bull markets, the 2000 bull market, the gold price went from $252 to $1,900. A 6 or 7-fold move? So my suspicion is that if you have 6 and 7-fold moves in the immediate background, by the way, for the same reasons, I think that this bull market has a ways to go. It's difficult for me to understand a circumstance where there isn't political pressure to continue the very policies that are responsible for the move in gold. And make no mistake, while gold moves based on fear, it isn't general fear. It's fear about the depreciation of the purchasing power of people's savings denominated in U.S. dollar savings instruments, in particular, the benchmark, the U.S. 10-year Treasury. And I don't see any political will to allow free market interest rates. I don't see any political will to eliminate counterfeiting or quantitative easing. And I don't see any political will on the part of Democrats or Republicans to constrain spending. The Republican that we have in place, first of all, was a lifelong Democrat, of course, until it became more convenient for him to be a Republican. But it's worthy to note that the federal deficit in the month of July alone, in 31 days, topped $850 billion. That isn't what you or I would characterize as restraint. And I don't see any political will or any political pressure to put in place any policies that would be bad for gold.
Mm-hmm. Well, and not only, I don't even see how they could even do that realistically. I mean, at this point, with the way the deficit's going and debt spending and all this stuff, I don't see any way out of it but devaluing currency, and reducing purchasing power. I don't see how you get out of that. And it becomes this death spiral kind of thing.
I agree with you. There was a very courageous man in the early 1980s named Paul Volcker. And he said that he was going to eliminate inflationary expectations. And he did. He took the interest rate up to 18%. And we had a good old-fashioned default cycle. Lots of people went broke. Lots of people became unemployed. In other words, we had to take the pill. I don't see the political will to take the pill anymore. The other thing is that at least the United States came into both 1970 and 1980, different circumstances, in a much stronger financial condition. In other words, there was lots of room left on our balance sheet to borrow. And there was lots of room in the federal deficit to service debt. There is less room now. The truth is, it seems to me that the system exists on confidence and fraud. Remembering that in a political circumstance, not in the Oxford Universal Dictionary circumstance, but in the political circumstance, the root word of confidence is con. And where we find ourselves right now is enjoying a bubble of confidence, a bubble that's put in place because people believe in the Fed put. And the sort of sense that you can conjure up new currency units out of thin air, and this somehow isn't destructive in the intermediate term. It is, and it will be. I just can't tell when we pay the price.
I hate to end on that kind of note because that kind of made me a little bit But it's realistic. It's.
I'll tell you, there's a futility to pessimism because we'll get through this. We will get through this. It won't be pretty, but we will get through it. I've been saying in a lot of interviews, the truth is, and I'm speaking as an American now, not as a Canadian, but it holds true for both countries. Individually, we're tenacious. Individually, we're creative. Individually, we're ambitious. The truth is that individually, so far, we've been able to generate enough value that we've been able to afford our collective stupidity. And the circumstance that I foresee is that we do it again. But the interim will be unpleasant, and you need to take into account the interim. And the way that I take into account the interim is by buying gold for insurance purposes and buying gold equities because at current gold prices, they feel cheap. And I don't see another asset class in my own mind that will allow me to improve or at least hold even with regards to my financial circumstance that comes close right now to rivaling precious metals and precious metals related investments.
That's okay. So let's end on that optimistic, a little bit more optimistic note. Rick, as always, it's a very pleasure speaking with you. Thank you very much for your time.
Thank you for the ability to address your audience. I appreciate it.
Thank you for watching Kitco News. For the latest in the precious metals markets, go to kitco.com. Stay safe, stay healthy.